Would you like to invest in stocks and shares? Or perhaps you are interested in mutual funds and index funds, but you don't know which ones to buy or where to start? If yes, then this video is what you should be watching. So stay tuned. Hello friends, welcome back to my channel, The Bulletproof Life. It's me, Ronke Odewumi, and as usual, I'm super delighted to have you here. Today, I'm going to be sharing with you 6 funds for building wealth. 6 funds you should be buying for building wealth. When it comes to investing in the stock market, you have a variety of options, going from stock and shares to mutual funds, index funds, real estate investment trust, and so on. So many things you can invest in to grow wealth. But today, I'm going to be sharing with you 6 funds based on their historical performance, based on their forecast, that are ideal for growing wealth. Just to get us started on what a fund is when your money is pooled along with the monies of other people and invested in securities such as equities and bonds. A fund can be a mutual fund or an index fund or an exchange-traded fund. Exchange-traded funds are traded directly on the stock exchange. An index fund is a fund that tracks a particular index, which I'm going to be talking about a lot in this video, and it's possible for an exchange-traded fund to also be an index fund. While a mutual fund is not traded on the stock exchange, it's usually actively managed and has a fund manager who is actively managing it, and also gives you the opportunity to invest in a wide variety of securities and spread your risk around. But before I go into talking about these 6 funds and why you should be buying them, please can I ask you to take a minute to smash the like button for me? Please press that button that has a thumb up so that YouTube can share this video with other people like you. If you haven't subscribed, please do it by pressing the red button on your right. Don't forget to press the bell so you can get notifications every time I share a new video. Thank you for pressing the like button. I appreciate you for that. So let's get into these 6 funds for building wealth. The first fund I'm going to tell you about is a fund that's based on the S&P 500, and it's the Vanguard S&P 500 exchange traded fund. So if you're somebody who has an account with Vanguard Investor, you can easily buy that fund from there. You can also buy it from other platforms, but it's a Vanguard product. Now, this fund invest in stocks in the S&P 500 index, which represents 500 of the largest US companies. So by buying this fund, you are getting an opportunity to invest in the 500 top US companies. And the goal of this fund is to closely track the index return, which is considered a gauge of overall US stock returns. So that fund closely tracks the S&P 500 and mimics its performance. And in so doing, it offers high potential for investment growth. Now, it's a fund that is invested largely in equity, which means shares. So the value can rise and fall more sharply than that of funds that are holding bonds rather than equity. I believe the risk level for this fund is about 6 out of 7. So it's a fund that's more appropriate for long-term goals where your money's growth potential is essential. So it's a fund that is growing well. If you have put in $10,000 in 2016, your money would be worth a little over $20,000 today. So the Vanguard S&P 500 is a fund you need to be looking at buying. The second fund I think you should consider buying is the Fidelity 500 Index Fund called the FXAIX. This fund is an open-ended investment fund. It's a mutual fund, slightly different from the S&P 500 ETF because it's a mutual fund, so it's actively managed. It's not a passively managed fund. This investment fund seeks to provide investment results that correspond to the total return performance of common stocks publicly traded in the United States. The fund normally invests at least 80% of assets in common stocks that are traded in the US, including the S&P 500 index companies. So this is another fund that invests heavily in S&P 500 companies, the top 500 companies in the US, and mimicking the performance of these companies by buying the stocks and shares of these 500 companies. And just to give you an idea of the kind of companies that this fund is invested in, its top 5 investments are in Apple, Microsoft Inc., Amazon, Facebook, and Tesla. This fund has had a good performance in the last 10 years. In fact, if you put in $10,000 in 2016, your money will be worth a little over $20,000 today. So the performance is quite similar to that of the Vanguard S&P 500 ETF. Risk-wise, it's a well-balanced fund. It gives returns that are commensurate with a median level of risk. The third fund I think you should be looking at, researching, and considering to invest in is the Baillie Gifford American Fund. Now, the Baillie Gifford American Fund is a fund I'm personally invested in, and I've invested in for a while, and I love it. It's a US large cap growth equity fund, and it's also benchmarked against the S&P 500, which means that it buys a lot of the S&P 500 companies. In fact, this fund was considered the best performing fund in 2020 by a lot of analysts. This fund aims to outperform, after deduction of cost, the S&P 500. So it's not only mimicking it, it's aiming to outperform the S&P 500 as stated in sterling by at least 1.5% per annum over a rolling 5-year period. As a fund that's actively tracking the S&P 500, about 90% of this fund is invested in US companies, companies that are listed, incorporated, domiciled, or operating out of the US. And it's a fund that's also performing excellently. This fund has a large number of top performing companies in its portfolio, so that when you buy it, you're basically investing in these top performing companies. Your funds are spread across these companies, and the top holding of this Baillie Gifford American Fund includes Shopify, Amazon, Wayfair, and Roku. 98.5% of the stocks are invested. Only about 1.5% of this stock is held in cash. And just to give you an idea of how well Baillie Gifford American Fund is performing or has performed in the last 10 years, if you put in $10,000 in 2016, your money will be worth a little over $42,000 today. So Baillie Gifford American will have times 4 your money in the last 5 years. It's a fantastic fund. The next fund I want you to consider is also an exchange-traded fund and also a Vanguard one, and is the Vanguard FTSE 250 UCITS ETF. Long name. Anyway, this fund is an ETF, it's an exchange-traded fund, so obviously it's passively managed. It's not a fund that is actively managed or indexed. It's passively managed, and it's a fund that acquires securities and then seeks to track the performance of the FTSE 250 index. This is another index different from the S&P 500, and is an index that comprises the 250 companies in the UK that are mid-sized, and it goes on to track or mimic this index. In tracking the performance of this index, this fund attempts to replicate the index by investing all or substantially all of its assets in the stocks that make up the index. Anytime I tell you that a fund is tracking or mimicking an index, what I'm really saying is that that fund is buying all the stocks and shares of that index, or buying the stocks and shares of that index and using the weighting that that index has given the stocks and shares. So if a stock or share owns a particular percentage of an index, then the fund that is mimicking that index will also buy that stock in that particular percentage. So that's something I want you to bear in mind, because I keep saying is mimicking, is tracking, is behaving like. It just means that that fund is buying the securities or assets that make up a particular index in order to mimic or beat the performance of that index. The Vanguard FTSE 250 fund that we're talking about now, which is an ETF, is a fund that's domiciled in the UK, so it's currencied in pounds, and it aims to remain fully invested except in extraordinary circumstances. So it's a fund that is fully invested in equity. It's not holding your money in cash. It's invested in these mid-sized companies that make up the FTSE 250. Now, the fund may use derivatives to reduce its risk or cost and to manage the income, but largely it's invested in equity so that it can maximize its performance and it can adequately mimic the FTSE 250. While this fund is a well-performing fund, is a fund that does well over the years, it's not recommended for short-term investing. This is not the kind of fund you buy, hold for a year or 6 months, and then you sell. This is a fund that you want to hold for 3 to 5 years at the minimum, so that you can get the best growth for your money. Income from these ETF shares are normally paid out quarterly in pounds. Additionally, ETFs, including this one, are listed on a stock exchange where you can buy and sell them through a company like an investment platform like the Vanguard platform, like Agris Lansdowne platform, like AJ Bell You Invest. You can buy these ETFs through these platforms and you will get the same day price because it's quoted on the stock exchange. So it's an immediate price kind of thing. You get the price and you can buy it as long as the stock exchange is open for business. The next fund you should be buying is also a UK-based fund, which is currencyed in pounds, and is the Ishares Core FTSE 100 UCITS ETFs. I keep bringing you all these long names. I'm so sorry, but that's just what this ETF is called. This fund is an exchange-traded fund again, which means that you can buy it on the stock exchange as long as the stock exchange is open for business, and is an ETF that aims to track the performance of the FTSE 100 index as closely as possible. This ETF invests in securities of the companies that make up the FTSE 100, which are the 100 largest UK stocks by full market value. So when you invest in this particular fund, you are really investing in the largest companies. Your risk is low, in my opinion, because it takes a lot for all 100 companies to just misbehave or to just perform poorly for a long time. So iShare ETFs is a great investment to make. They perform really well. They've performed well in the last 10 to 5 years, and this ETF has been able to successfully mimic the performance of the FTSE 100, which it is tracking. Again, being an ETF, this fund is passively managed, which means that the costs are also likely to be low. I think something I should mention is that funds can be actively or passively managed. You've probably picked that up in the conversation so far. And funds that are passively managed tend to have lower costs than those that are actively managed. So that's one thing I want to put out there for you to understand. This particular fund is suitable for medium and long-term investment. So if you're somebody who is looking to invest in something for 3 years, this is a good fund to do that with. It's suitable for medium investment, it's suitable for long-term investment, and you can put your money into it and expect decent returns in 2 or 3 years. If you are interested in buying this particular fund, you can access their prospectus product page on blackrock.com. This is the name of the company that manages this particular fund. Now that brings me to the last fund I want you to consider. Also a UK fund is the Ishare UK Dividend UCITS ETF. I'm writing it on the screen, so don't worry about how long this name is. This particular fund is high on dividend paying. It's a fund that pays a lot of dividends. It comes with a 6.6% dividend that beat the UK market comfortably. If you are somebody who is big on dividends, this is the fund for you. This fund seeks to track the performance of an index that is composed of 50 stocks only. 50 stocks with leading dividend yields from UK listed companies, excluding investment trusts. And just to show you what a strong performing fund this is, its top holdings include British American Tobacco, Vodafone, British Petroleum PLC, National Grid, Legal and General Group, Rio Tinto, and Imperial Brands. These are big companies. If you are somebody who is against sin stock, you might want to avoid this because it's invested in British American Tobacco. So if you are not a fan of investing in tobacco, this might not be the fund for you. The beauty of this fund is that it's also traded on 4 different stock exchanges. It's traded on the Italian exchange, on the Dutch exchange, on the Swiss exchange, and of course on the London Stock Exchange. Now that I have shared with you 6 funds you should be researching and buying this year, I hope you've enjoyed this video. I hope you're going to click on the like button for me. Share this video with your friends. Tell them about it. Subscribe. Press the bell so you can get notifications every time I share a new video. I love bringing you these videos, but it encourages me more when you like this video, when you drop me a comment, when you let me know that this video is impacting you. Then I go back to work on creating more videos for you because I know that you are enjoying them and I'm making a difference. Until my next video, you take care of yourself and keep living that bulletproof life. Bye-bye.